With the banking turmoil hearing underway, lawmakers are weighing whether raising insurance limits on deposits could prevent more trouble down the line. Joining us now to discuss further is veteran business columnist Joe Nocera. Joe, great to have you here with us this morning. Do you believe that is one of the easy, low-hanging fruit? And I say easy and low-hanging fruit kind of with air quotes because it is quite difficult to actually get that through at the end of the day.
Yes, no, it's totally true that it's hard to get it through. But I actually think that you could have a system where you insure all deposits, and you would prevent bank runs. They would go away because so much of the banking system depends on psychology, and if people think their bank's in trouble and they make a run on the bank, there's no bank that can survive all of its depositors taking its money out at once. So, it's been suggested by several people, several academics and others, that a way to solve the problem is to give deposit insurance to all deposits, no matter how big. And I actually think it makes a lot of sense.
On the other hand, Joe, it's Julie here. Thanks for being here. On the other hand, there are some who say, that would encourage risk-taking behavior if you just said, okay, everything's insured from henceforth. Do you think that's the case?
I don't. I mean, we already have a system where every time one of these things happen, going all the way back to the S&L crisis in the 1980s, whenever it happens, the government says, oh, it's an emergency, so we're going to insure all deposits. We don't want our depositors to lose any money. And that's what happened in this case. So there are people who had, millions and millions of dollars in the bank in a deposit. They were using it for payroll and other things. And the government said, you're not going to lose any money. Don't worry. And that's what happens every time one of these things happens. So why not just, say, be done with it? And the truth of the matter is the risk. I mean, look, Silicon Valley Bank proves that you can take stupid risk with uninsured deposits. I mean, they prove it. And, the risk that these guys are taking really now comes down to the risk that they're going to lose their jobs, the risk that shareholders are going to be wiped out, the risk that bondholders are going to be wiped out, and the risk that their bank will be taken over by another bank. Those are the risks. In the world that we live in right now, there is very little risk associated with deposits.
So in talking a little bit more about the risk of your bank getting taken over by another bank, what also comes time and time again when this does happen is you have some type of fire sale that gets to go through just to save any type of confidence in the system, but also for the deposits or for the loans that bank is responsible for. And that gets absorbed by usually some larger bank, and that large bank that is probably too big to fail just becomes even bigger. So what are we to make of that side of what takes place after these crises time after time again?
Well, I mean, this is the way government has dealt with banking failure, really, or practically going back to the Depression. You get a big, healthy bank to take over a struggling bank that excuse me, that is at risk of failing, or indeed has failed. Now, in the case of Silicon Valley Bank, their loan portfolio was not the problem. They made good loans. Their problem was they mismanaged their internal risk with their bond portfolio. And so the bank that's the First Citizen that's taking over SVB, they're getting a really good loan portfolio that's going to make them some money. Now, it doesn't always happen that way because there are times that banks get in trouble because they make horrible loans. You can go back to the Penn Square fiasco and so on and so forth. But as a general rule, the big bank that takes over not only takes over the deposits and gives confidence there, but they take over the loan portfolio and give confidence to the borrowers.
And what are some of the other things, Joe, do you think that could, as you say, whenever these crises happen, you sort of look back, you try to figure out what to do. Besides the deposit insurance changes, they're doing this hearing right now. We see Sherrod Brown posing some questions or just talking. What do you think is going to come out of this besides that? Are there going to be some other measures that you think regulators are going to come in with here?
I hope so. Look, I was sort of stunned when Michael Barr said it's not our job to fix the problems. It's only our job to point them out. If JP Morgan or Wells Fargo had a systemic internal problem that was caught by the regulators, there's pretty much no way the regulators would say, boys, fix it. We'll see you in 6 months. I mean, that just wouldn't happen. So, I think you have to bring back the stress test. SVB, got that exemption from the stress test, as all those banks that size got. And I think they need to reimpose the sensible regulations that had been imposed after the 2008 financial crisis. Honestly, I think a lot of these problems could have been avoided with the regulations that had been put in place.
Right, that were then rolled back several years ago.
Right.
We'll see if that comes up today. I imagine it will, at least on one side of the aisle.
Yeah, maybe 100 times.
Yeah, veteran business columnist Joe Nocera, great to get your perspective this morning as we monitor this hearing. Thank you. Appreciate it.
Thank you. Thanks for having me.